What's up, wealth builders? Welcome back to Build Wealth Now News. I'm your host, Billy Bob, and today we're diving deep into one of the most talked about AI stocks in the market, Palantir Technologies, ticker PLTR. The stock has been on an absolute tear, up over 60% in the last year. But of late, it has pulled back like many other software companies such as Adobe, The Trade Desk, and so on. Is it the time to buy Palantir? Joining me as always is our market analyst, Sarah. Sarah, welcome back.
Thanks, Billy Bob. Great to be here. And wow, Palantir has definitely been one of the standout performers. But there's a lot more to this story than just the price movement. Today, we're going to break down the fundamentals, look at the charts, and help our viewers understand if PLTR fits their portfolio.
Perfect. So let's get into it. For our viewers who might not be familiar, what exactly does Palantir do?
Great question. So Palantir builds AI software platforms that help organizations make sense of massive amounts of data. They have three core platforms: Gotham for government and defense intelligence, Foundry for commercial enterprises, and their newest platform, AIP, the artificial intelligence platform, which is really driving their recent growth.
And how do they actually make money from this?
It's pretty evenly split between two segments. About 51% comes from commercial customers, large enterprises in healthcare, energy, manufacturing, and financial services. The other 49% comes from government contracts, mostly U.S. defense and intelligence agencies. What's really interesting is their U.S. commercial revenue exploded 137% year over year. That's the growth engine right now.
So they're not just a government contractor anymore. They're breaking into the commercial space in a big way.
Exactly. And that's crucial because it diversifies their revenue and reduces dependence on government budgets.
All right, let's get to the charts. Our viewers love seeing the actual numbers. Sarah, walk us through what we're seeing here.
Let's start with this first chart showing the current ratio, quick ratio, and debt to equity. Billy Bob, what jumps out at you?
Well, that blue and orange bar are just climbing steadily year after year. The current ratio is now over 7, and the debt to equity is basically 0.
That's exactly right. The current ratio of 7.1 means they have $7 in current assets for every $1 in current liabilities. That's incredibly strong. And look at the purple bars. Debt to equity has gone from 2.7 back in 2019 to essentially 0 now. Palantir is debt-free with over $7 billion in cash. This is a fortress balance sheet.
So for our viewers, this means they can weather any storm, invest in growth, and don't have to worry about interest payments eating into profits.
Precisely. This gives them tremendous flexibility.
Okay, let's move to this next chart. This one shows the margin trends, and wow, what a transformation.
This is where the story gets really exciting. Look at the blue bars. Gross profit margin has been consistently strong, around 80% plus. But look at what happened to operating margin. That's the orange bars. They went from negative 107% in 2020 to positive 31.6% in the latest period. That's a 140 percentage point improvement.
For our viewers who might not follow this closely, what does that tell us?
It tells us Palantir has achieved something called operating leverage. They're growing revenue fast, 56% year over year, while controlling costs. Every new dollar of revenue flows straight to the bottom line. And look at free cash flow margin, those green bars now at 46.9%. That means for every dollar of revenue, they're generating 47 cents in actual cash. That's world class.
And the net profit margin just turned positive at 36.5%. This company is printing money now.
They absolutely are. This is the inflection point every growth investor looks for.
All right, final chart. This shows revenue per share, EPS, and cash flow per share. The blue bars are just skyrocketing.
Revenue per share is up to $1.70, but look at the earnings per share. Those orange bars went from negative $1.20 in 2020 to positive 63 cents now. That's nearly $2 per share improvement. And free cash flow per share, those green bars, is now 80 cents and growing.
So shareholders are seeing real value creation, not just revenue growth.
Exactly. And this is why the stock has performed so well. The market is rewarding them for proving they can scale profitably.
Okay, so the numbers are impressive. But Sarah, what about competition? Can't Microsoft, Google, or Amazon just copy what Palantir is doing?
That's the million-dollar question. We assess Palantir as having a narrow moat that's widening. They have two key advantages. First, switching costs. Once a company integrates Palantir's platform into their operations, it becomes mission critical. Removing it would disrupt decision-making across the organization. We see net revenue retention above 120%, meaning existing customers are spending more every year.
So it's sticky. Once you're in, you're in.
Very sticky. Second, they have intangible assets, 20 years of relationships with U.S. defense and intelligence agencies, security clearances, and domain expertise that's incredibly hard to replicate. Their AIP platform combines proprietary technology with this deep expertise.
But you said narrow moat, not wide. Why?
Because competition is real. Microsoft, Google, and AWS are all embedding AI capabilities into their existing enterprise suites. Palantir has to keep proving their integration depth justifies premium pricing. They're not invincible, but they have real advantages that should last 3 to 10 years.
Let's talk about what's going to drive growth from here. Is the easy money already made?
I don't think so. There are three major growth drivers. First, the AIP platform launch. They closed 180 deals worth over $1 million each in Q4 2025 alone. This is a step change in their product capability.
$180 million deals in one quarter? That's insane.
It is. Second, customer expansion. Their U.S. commercial remaining deal value, RDV, grew 145% year over year to $4.38 billion. That's a huge backlog of future revenue. Third, they're still early in geographic expansion. Only 26% of revenue is international right now.
So they're growing through new customers, existing customers buying more, and new markets. That's the trifecta.
Exactly. And they're doing this while expanding margins, which is rare. Usually you have to choose between growth and profitability. Palantir is doing both.
All right, Sarah, I played devil advocate for our viewers. What could go wrong here? This seems almost too good to be true.
Great question. And there are real risks. First, valuation. The stock trades at a PE ratio of around 218 times earnings. That's extremely high. It implies perfection. Any slowdown in growth or margin expansion could cause the multiple to compress sharply.
So even if the business does well, the stock could go down if it doesn't do great?
Exactly. Second, concentration risk. 41% of revenue still comes from U.S. government contracts. If defense budgets tighten or political priorities shift, that's a real headwind. Third, competition is intensifying. The hyperscalers, Microsoft, Google, AWS, are not sitting still.
And I imagine they have deep pockets to compete.
They absolutely do. Palantir's defense is their deep integration and mission-critical deployments, but they have to keep executing flawlessly.
So let's talk valuation. Is there a number where this makes sense to buy?
Here's the thing. Palantir is now in what we call Phase 5, capital return. They're profitable, generating massive free cash flow, and they even started buying back shares, $75 million in fiscal 2025. The appropriate valuation methods are trailing PE and price to free cash flow.
But those multiples are still sky high.
They are. PE of 218, price to free cash flow around 260. For context, the S&P 500 trades around 25 times earnings, so you're paying a massive premium. The question is, will growth justify it? If they can maintain 30% plus revenue growth and keep expanding margins, the stock could still go up. But if growth slows to 20% or below, you could see significant multiple compression.
So what's your take for our viewers? Buy, sell, or wait?
I'd say it depends on your risk tolerance. If you're a long-term believer in AI and enterprise software and you can handle volatility, a small position makes sense. But I wouldn't chase it here. Maybe wait for a pullback to the $100 to $110 range, which would still be expensive but more reasonable. And definitely dollar cost average. Don't go all in at once.
So not a slam dunk buy at these levels, but not a sell if you own it either.
Exactly. It's a hold if you own, wait if you don't situation for most investors.
All right, let's wrap this up. Sarah, give me your 30-second summary for our viewers.
Palantir is a high-quality company with a strong moat, exceptional margin expansion, and real growth drivers. But the stock price reflects perfection. Great company, questionable valuation at current levels. If you're investing, size appropriately and be prepared for volatility.
Perfect. And for our viewers, remember, this is not financial advice. Do your own research, understand your risk tolerance, and make decisions that fit your financial plan. If you found this analysis helpful, smash that like button, subscribe to the channel, and hit the notification bell so you don't miss our next deep dive.
And drop your questions in the comments. We read every single one and often feature viewer questions in future episodes.
Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk, and you should do your own research before committing any stock to your own portfolio. This video is done for educational purpose only.